Good morning, everyone. Welcome to the room. As you know, trading futures involves risk, not suitable for all investors. Information in the presentation is for educational purposes, not a trade signal service, not intended to be financial advice. Hope everyone's week is off to a good start. Yesterday was kind of the price action that I was sort of expecting to see last week, in that, we kind of broke our trend or pattern of holding the swing lows like I talked about in yesterday's market analysis video. All of these swing lows going back to the beginning of the year in the E-mini S&P here, all of these swing lows have held. We haven't broken one of them until yesterday. And last week, if I were to draw up the little channel, very tight channel that we've been in, we kind of hug the top of it, maybe break out one day and then fall back and hug the bottom, back to the top, hugging the bottom, a real tight, we'll call it maybe a 50-point channel, if that. And then last week was kind of the first time where we'd been going to the top and then sort of drifting sideways. As soon as we hit the bottom, we'd move back to the top, and more of a moving up and then hugging the top of the channel, and then kind of fall down 1 or 2 days and then right back up to the top of the channel. Last week was the first time where I saw us kind of not gravitating towards the top of the channel so much, more moving horizontally. And you can really see that on the market profile. And I can pull that up where, we have this day's high and then a spinning top candle. Then we have the open from this day, the low from this day, sort of forming more of a horizontal support and or resistance level. And then both times that we opened up above, actually 2 of the 3 times that we opened up above 2800s, which is the 2802, is just this swing high from back here. The only days that we were able to open up above those levels, the one day here on Friday was, I would consider, the strongest because we were able to close above that level. And the other 2 days, we gapped up and then we sold off. And it's that sort of gap up and sell off that I look for sort of the end of the uptrend, or at least a deeper pullback to come. And if we don't get that deeper pullback, like we move down below the swing low over here, if today we just, or even later this week, we just kind of take off back to the upside, well, now you have a lot of folks who got out of, a lot of short-term traders and even some swing traders, maybe people who put on positions at the beginning of the year who decided, okay, it's time for me to take some profits at this point. Or, okay, I want to put on a hedge at this point and kind of protect myself from the gains, or protect my gains that I've made. I want to hold on to this position longer, but I want to hedge, put on a short, so that if we do go down, my gains don't all disappear, and I can capitalize on that pullback. If all of those folks end up being wrong, meaning we break Monday's high or the swing high, then all of a sudden you have a whole bunch of groups of people saying, well, shoot, I need to close out of my hedge. And so then that sends the market, I need to buy back my hedge. I'm being stopped out of my short. You have traders, shorter term traders, saying, oh, okay, well, the move down isn't materializing, so I need to jump in and buy to get in the long, with the trend. And so you have a whole bunch of different groups that are then sort of restarting and putting on new or versions of new long positions, whether it's covering a short or initiating a new long. So when you have a day like this, a big bearish engulfment that kind of breaks the norm for the last couple of weeks or couple of months, it can be good in both directions. We either, get a trend to the downside for, hopefully longer than just 1 or 2 days, or we resume the uptrend and it's very, very strong, and there might be 1 or 2 opportunities early in a day to get into a trend, and then you end up having a big trend day. So I'll talk a little bit more about some of the things that I noticed yesterday, but let's talk about this morning first. So far, kind of like last Tuesday, where we opened up at a 1-to-1 breadth and about as even as you can get in the advanced decline line, meaning the bulls and the bears are basically, pushing and pulling at each other evenly. So the number on the left is the breadth, and that's a volume ratio. So you see this minus 1.1 to 1, and that just means that the amount of volume that's flowing into stocks moving up versus moving down on the New York Stock Exchange is 1-to-1. It's balanced, it's even. So any number closer to 1-to-1 is going to be more balanced. Any number, 3-to-1, 4-to-1, minus 3-to-1, minus 4-to-1 is going to be more extreme. And obviously, when you get to 8 or 9 or 10-to-1, that's super extreme. And then this number over here on the right, the advanced decline line, that's just the net number of moving up versus moving down on the NYSE. And so you have basically the same number of stocks going up versus down at this point. When you get a plus 1,000 or minus 1,500, now you're getting in the more extreme polarized where you have a lot swung to one direction. And then same with this box here, the NYSE tick. 0 is this horizontal line down here where the last movement in the stocks that make up the NYSE was net 0. So you could have had 1,000 moving up and 1,000 moving down, and you net 0. When you get a plus 1,000 NYSE tick, now you're seeing way more stocks that are ticking up all at the same time, or minus 1,200. A whole bunch of stocks ticking down all at the same time. And then that's a much more actionable number. You can have a lot more variables. So you ask yourself, okay, how can I get to a minus 185 on the NYSE tick? Well, you have up, down, and unchanged. So you could have a lot of stocks that are unchanged, and then you could have 400 stocks moving up and 215 stocks, or vice versa, 215 stocks moving up and 400 moving down, and then the rest unchanged, and so you get minus 185. Or you could have 800 moving down and 615 moving up, and so there's a lot of variables, a lot of different combinations. But when you get into the plus 1,000, plus 1,200, now we know that you have to have at least 1,000 or 1,200 moving up just to get that reading. And so the extreme numbers are much more valuable in terms of actionable information. I guess you could say that a 1-to-1 or a very small number is a helpful way to determine inaction. But the most important with all of these, I guess with the breadth and advanced decline line, a little bit less in the NYSE tick, is where have we come from? For instance, right now we're at 1-to-1. Well, if in 30 minutes we're at minus 3-to-1, well, that's a decent move. Whereas if we open at 3-to-1 and a half hour later we're at 3.2-to-1, things have pretty much stayed the same. So then you can cross-reference, okay, what has the trend been in the breadth? where has volume flowed with where has the NYSE or where has the S&P moved? And so if we have a breadth that opens at 1-to-1, and in 20 minutes or 30 minutes it's at -4-to-1, but the S&P is flat, I might infer that we may have a sell-off coming because more volume has been going into stocks that are moving down, but the S&P may have not caught up yet. And those kind of things can be helpful to kind of get a gauge, just like I would look at the VIX and say, okay, yesterday's swing high and swing low have not been broken. If today the VIX was breaking down below lows, but the S&P wasn't breaking above highs yet, I might infer that the S&P was lagging and we should get a rally. If the S&P sells off today, if we break yesterday's low in the S&P, but the VIX doesn't break yesterday's high, I might be looking for some opportunities to get long or to take a counter trend move. But if we have a selling off S&P and a rallying VIX, then those two confirm each other because they're inverse. If we look at the S&P, the SPY rather, I always like to keep an eye on the top four. So the S&P, the Dow, the NASDAQ, and the Russell. The S&P has kind of come up here and broken this swing high, and then also broken the swing low. But the Dow didn't. It made a lower high and then broke the swing low. So if you're looking to place a short or a hedge, out of those four, I always come in and kind of look at, okay, well, the NASDAQ also made a higher high, and then the Russell, that made a lower high, and it didn't break the swing low here quite as far as the Dow did. So then I say, okay, well, the Dow is the weakest, then the Russell, then the S&P, and then the NASDAQ. So if I wanted to put on a short as a swing position or a hedge, I would do it in the Dow. I just use you could use the DIA. If I wanted to put on a long, I would say, well, which is the strongest? And clearly it's the NASDAQ. So if we get a pullback and I want to put on a swing position, I would either be looking for stocks in the NASDAQ, or you could do it in the Qs itself. I would not put on a position in the futures that I would try and hold overnight. I would never hold past the close in the futures markets because there's just too many variables, and futures is a market where you can actually lose more so in theory. Your broker's likely going to close out the position before your account goes to zero or goes beyond zero, but in theory you could lose more, and in actuality with futures. Top of the hour today, we've got new home sales and non-manufacturing index, jobless claims Thursday, housing starts and employment on Friday. So kind of the standard numbers, ADP employment on Wednesday, tomorrow. So some kind of standard numbers coming out that should help this market continue to move. That overnight important number was this 61.8 here. If I take the 30-minute on the ES, and I'll show the extended hour so you can see how we came right to it. Right here. Came right up to the 61.8 and then have rolled over a little bit. So what do we do next when we have a short drawn up? And notice, even if we were to put the overnight high to lows, that gives us an even stronger short. That raises up to 50, raises up to 61.8. But anytime I have a high to low drawn where a short has traded, I like to draw the low to high. In this case, I might just look at where, I need to sneeze here. That's better. I look at where the low to high using the overnight is, but once I turn that off, I'm really more concerned about if we stop at the low to high from trading hours only. And 94.50, 95. So it'd be something like this, a 27.81.25 from yesterday's low to today's high thus far. I'm also looking at, we've got, here's kind of some horizontal, we've got highs from this day, highs from over here, lows from over here, lows from this day. So that 27.92, this 50% here is kind of a bigger level, and there is support and resistance on both sides of that. Otherwise, the high and low from yesterday are pretty much the major highs and lows to be referencing. Overnight, I'm going to turn that information off now that we can see where we went. We rallied, then we sort of drifted back down. And if we come into the trading hours only here on the ES and just looking at, okay, what did things look like, or what have things been looking like in the first 15 minutes? Well, we have a short that's traded. We haven't quite reached the negative 23. We have another short that also traded, a little bit dirty, meaning both of these kind of went in and traded beyond the 50% a little bit, but they have rolled over nicely and coming down to their negative 23. Yesterday's close was basically where we opened, so there's no real gap fill, but we have the long below us and the short potentially rolling over, so a couple of signs moving us lower. Yesterday, we didn't have a whole lot of low ticks at lows, and you see that on a trend day. You get low ticks in the NYSE tick, but they don't line up with low price. So today, I'll also be looking for, because it's a more even breadth in advanced decline day, I would be looking for low ticks that line up with low price in the attempt to maybe take some counter trend trades if we're going to maybe move sideways between these two levels. And maybe we don't move sideways, but we have a better chance of it on a day like today versus yesterday, even though the first hour was a little bit more range bound. It was pretty messy. We were breaking through 61.8s quite a bit. $44s, 45. So here we have a low ticket 44s, but a low price at 45s. So we do not have a low ticket lows, which means we could continue to go lower. So I'm going to draw up this next short. If we get a bounce, and look for an entry there. If you draw up from highs to lows, that would give us the trading hours only retracement that should take place a little later in the morning. In some situations like here, where we go down through the negative 23 and then the negative 61.8, this next short ends up being a little bit extended and a little bit higher risk. If we draw up the high to low, see how this 50 is a little bit a ways from the next 50 here. And so sometimes I kind of deem, or you have to assess, has the trade moved too far? do I want to take this short at 88.50s, or do I want to wait for it to come back up? At least this morning, we're starting to see some better sort of adhering to, at least so far, shorts this morning, and so that's a good sign. The other thing I take into consideration is, with a pretty balanced breadth and advanced decline line, when we get a bigger move in one direction like this, more often than not, we'll see a retracement back further, as opposed to just selling off from here and having another huge down day. But with the new home sales, just a couple of numbers at the top of the hour that could serve as a catalyst, that could, I'm keeping my eye on the breadth for a change. I'm also keeping my eye on the NYSE tick for a change, or for a low tick at lows. Let's take a look at so we've broken the negative 23 and the negative 61.8. I know some of you are familiar with drawing extensions. I don't like to take trades at extensions, because by definition, to me, it's sort of saying that the market is overextended. So rather, see how I have a high to low, rather than drawing a low to low and trying to take that 50%, I'd rather let it come further back, let it make a bigger retracement. I'm going to draw up this retracement here. I don't have a limit order at 88.50s. I'm also going to get rid of this first short, draw up the bigger short. And if we come up and touch somewhere around 90s, then I'd be okay taking a short, the first short after that. If this 88.50s rolls over here, and enough time goes by where it's not like 2 minutes or a minute before the number, and we might be able to come down to 81.25s and get a bounce. So I'm kind of already looking at where might the market bounce or a double bottom, or any kind of situation like that. If we look at, okay, where would the swing low be on this move up, such that we have the very first short after this larger, so on the 30-minute, I drew up yesterday's high to low. Okay, so here's that bigger level, 27.9275s that's trading. If we zoom in and say, okay, well, where would the very next short be on just a slightly smaller time frame? Well, we have a little swing low here, but it's not a major pullback. This is sort of the deeper pullback. And so the market would really have to come down and break this swing low in order to draw up what would be considered the first high to low. But then where does that put us? Right at the 50. So we would need really to break 27.78s to get enough of a breakdown to shake out any longs. But in the meantime, we can be taking trades in the 512. That's just the same process of, here's a setup on a larger time frame that I'm not placing a limit order at. Instead, I'm coming into a smaller time frame and taking the very next trade in that same direction. So I'm not sure, Rod, in terms of redrawing fibs. Let's say this trade right here made a little bit lower low. I would leave up my initial drawing. So if the market, so let me rephrase that. If I have a setup drawn and we touch the 50%, I leave that setup. That setup is in play. If I draw a retracement like this, and then like right here, we broke another tick, well, then I would just adjust that drawing down to lows. In a situation like this, where the market kind of makes a little stair-step leg and breaks the swing low where I have the anchor point here, you can use this swing high as a placement to tighten your stop. You can also draw up the next 61.8 and use draw up the next retracement and use 2 ticks above the 61.8, which is pretty close to that swing high. So here down, low tick, that does line up with low price. You can also use that signal when you get a low tick at lows. Granted, this isn't a very extreme low tick, but if the market does come down and we're making low ticks at lows, you can use that as a point to close out a portion of the trade. But what I would prefer to do is to just come in and trail each candle's high here on the way down. When you get a sort of extended, clean move down, keeps you in the trade a little bit longer. And look how quickly we've sort of gravitated down to this 27.81 1/4. So 53s and 53s, low ticket lows. So if we stop at 85s or 85.50s, then I don't like a long. If we can get any kind of break through it or stop before it, which it's too late for that, then I'm okay with a long. But if we stop right at it, even though we have a low ticket lows being pretty close to a number, that sort of adds a little bit, makes it a little bit higher risk. And that's okay. You know, you can go ahead and take a trade like that. You just have to, the idea is to always be looking at it from the risk side first. And sometimes what happens is you have a pattern of, the market acting in some way. Let's say that it's a really slow first 30 minutes all week, and then the next week, Monday, the first 30 minutes is great. And so then you can say, okay, well, things have changed, and so now Tuesday, I might get a little bit more aggressive earlier in the day. But it kind of takes that one day of, oh, things have changed, and the pattern has changed. Now it's okay to, kind of look for signs that might be able to get into a trade earlier in the day. So you don't feel like, oh, we had one day that's different and I missed out on everything. Use that day, which I'm kind of considering yesterday is a little bit different than days in the past. Use that day as sort of that signal day, and then you can make better decisions following that. So like last week, I really didn't have too many trades. Yesterday, I had 2 trades that I talked about in the video, those 2 shorts. The first one just made it to the 2-point target, and the second one got a decent drop, but it certainly wasn't the whole move by any means. And there wasn't, even if you trailed really conservatively, it would have been very, very difficult to stay in the entire move yesterday. There was just too much back and forth. All right, so we're getting a little close to the top of the hour, but I do like what we're getting here, breaking the 61.8. So 27.85 50s. Coming up into a high tick. Granted, it's not the high of the day. Here is the last swing low on the swing high on the move down. It would be nice, if we can break that. A low ticket lows or a high ticket highs is a strong signal in itself. I could go through and weight some of the different signals, maybe give them their own strength index or something. But there's our break of this swing high. So 27.85, 27.86s is where I'd place my long setup. So long as it'd be nice if it wasn't so close to the top of the hour. You don't always get a, quick shake move around a number, but I always try to be, as you can tell, for those that have been in the room for a long time, or for, more than a month. And the last 2 weeks have been kind of slow on Tuesday, but you catch some big moves without having to take excessive risks or a whole lot of trades. You don't have to take 20 trades to catch one good move. You're not going to be able to take one trade every day and catch the one good move, but it's okay to be a little bit conservative and still be a day trader. This was a short that was a little bit concerning up here just because that anchor point we sold off at this 88s. $81.25 is still a little ways below us as well. Not too far though, a couple of points below lows, so we shall wait till the numbers. Meant to look at the NQ. Pretty much the exact same pattern here. Didn't make its move all the way to the halfway back yet. Sitting at the long. We'll see what happens. All right, so up we go. The 2-point target obviously already hit. If I said this last week, do this, adjust that. I always in my brackets my first target is 2 points, and then you can adjust it to the negative 23. I don't bring it in, like I wouldn't bring it less. Maybe a point and a half at times, but rarely. I usually just leave it at 2 points. In a situation like this, where you have a little swing low dip up here, and we could get moving really quickly. First, I want to draw up the high to low. Okay, good. We're already through that. So let's split the remainder of this up into aggressive. So there's a high tick, not at highs, but I am going to trail each candle here, as well as I need to get this up. So I've got a portion still down, which happens to be below the swing low, 87.75s, and then I'm going to just follow along here on the middle third, 90. I got 90.50s is what I'll just leave it there for now. That way, if we do push a little higher, you can still stay in it, but if we come, if we drop down, then you're protected. Okay, so there's our 90-50. So now the last third I've got at 87.75. So that's why, I encourage, if you're trading sim, trade 3 contracts so you can get practice with multiple exit points. It doesn't do you any good to trade 1 contract on sim, because we want to focus on mastering just doing everything we can to master the method and the strategy. And you want to practice more than just placing your entries. You also want to practice getting out. So 3, you can break it up into thirds. Your first target at the -23 or 2 points thereabouts. And then you have a conservative trail and an aggressive trail. And that way, like this, I had a good question this week emailed in about, well, why not just place your entry at the 61.8 and your stop just 2 ticks below that? If I'm placing my stop below the 61.8, why not just place my entry as close to that as possible? Because in a lot of situations like this, the market reverses at the 50 and you wouldn't get filled if you placed your order down at the 61.8. Yeah, you might have smaller losers, but you're going to miss out on a lot more winners. And then I had another thought, but it left me here. Oh, then like here, okay, if you weren't in the trade, if you didn't get long at 86s, you draw up the next setup and you can put on a new long up here. Let me heighten this. You can then obviously just taking the next retracement. So here's the first one, which I guess still an 86, but I had it drawn like so. Putting on, here's the number 1. Then you take from that entry to highs. Here's number 2. And so taking, the first, second, the third trade in a run is totally fine. If you miss the first one, you can take the second one. If you miss the second one, you can take the third one. Now here with this double top, I'm going to take my stop and move it up underneath this swing low at 88.75s. And so in some cases, and here's a break of the little anchor point high, in some cases you don't get a full pullback to the 50%. Let's say we didn't come all the way down and this 50 traded. Well, if you're already long and you're scaling out, then you're already in the trade and you don't miss out. And if the trade comes down and dips in, you're reducing your risk from a full stop out as well. So now I'm going to bring my stop. I'm just going to check where the developing 61.8 is. And I'm going to move it up underneath this swing low at 90s. That way, if the next retracement pulls back and comes down to the 61.8, my stop is below that. And it just happens to be a nice little swing low here. And so with 3 contracts, you got a target at 2 points, an aggressive stop, and a trail stop. When you get down to that last contract, you kind of have to just be conservative with your stop unless you really get ripping, but you only have 1 more exit point. Well, if you can double that and get to 6, you can take 2 off at that first target, 2 off at an aggressive run, and then you can do, you can break up the last 2 into aggressive and conservative. Yeah, I felt like I was fairly clear, Victoria. I said, here's the long at 27.86s, but it can get a little bit. I'm trying to do a lot. I try and say, okay, here I'm drawing this setup up here, and I'm not taking it, or I'm not placing a limit order. I'm going to let it trade and then draw up the very first setup. Or, okay, we had a low ticket lows. I was talking about the swing high break, and 27.86 is being the long. It was definitely drawn up well in advance of the pullback. So. Breadth and advanced decline line still pretty even, which, for the market to rally and come back up to basically where we were here at the open, that makes a lot of sense. Here we are right on top of the swing low. So I have my stop at 27.90s. I'll just reiterate that. And there it goes. So now the next thing to do is look at where the full retracement is and not place an order right there. So I'm drawing up the full retracement and I'm not placing a limit order right at the 50. But if we stop here and get a little bit of a bounce, then I would look at the next long after that. Because I don't know if the market's going to stop here. I can say, well, let's go back and look at, did we hold the short? No, we're already through at 61.8. So now we have to see if the long holds. If we were in a series of longs, like if we had a big long below us that traded it, this was the 50 and this was the target, and then this distance between the 50 and the 61.8 wasn't too big, yeah, I could conceive placing a order there, but without any sort of sign that the market has made any kind of pause yet or continuation, I want to get a little bit of a clue. I want to kind of see the market's hand at some level, get a little bit of a hint if I can. And sure, there's going to be times where you assess the market like this short back here, and you say, okay, well, I'm going to pass on that trade, and it ends up going to a first target. And there's other times where you're going to assess the market and pass on a trade, and it ends up where it would have been a stop out. So you can't just think about, oh, I missed that winning trade. You also have to remember, oh, well, I also missed some trades that were losers too, and those kind of net each other out. So the mind games that the market can play with you, or that you can play with yourself, can be challenging. Let's get the high and low of the first 30 minutes drawn up, which is basically the high and low of the day. So where are we at? We're right in the middle of the first 30-minute range with a pretty even breadth and advanced decline line. If we look back at the day thus far, a long down at lows makes a lot of sense. A short, if we were up at highs, makes a lot of sense. So far, we're inside, meaning we're inside yesterday's high and low. We're also inside the first 30-minute high and low. And see here, yes, this might hold the 61.8, but if we rounded up and added a tick and pretended that I was long at 27.8975s, that puts our stop at 88.25, and you would have been below that. No, it would have been 88.75 and 87.25, so it would have come down 6 ticks. But I'd rather let it sort of see what happens here and then just come in. And most of the times, my order, my actual trade on the 512 tick chart that's the first setup after this larger drawing, I mean, it's very close to where that original, you're not missing out on very much by getting long at 89s instead of 8850s or 89s instead of 8950s. It's worth it to wait just a little bit. Yeah, exactly, David. You are saving a lot on the risk. So the large 50%, Mike, I've got here on the 30-minute chart, I've got the short, the large short. I don't see us tagging the 8125s yet. So between the 250s. Now, low tick at 11s. I just want to make sure we don't stop right at 9050s and end up right between 250s. That's another good way to kind of stay out. Sometimes, like, the long has traded already. That's good. I like a long here. We still have a low ticket lows. If we stop right at this 50, we could bounce between the two, and then that makes placing a long a little bit riskier. We also have to remember that we're kind of right in the middle of the first 30-minute range as well. So that kind of, if I was like on a sliding scale, I say, okay, the long has traded, good. Okay, that moves me a little bit more biased to the long side, or like to taking the trade. I'm more confident. Now I'm not confident because we stopped right at the short. So I'm not placing a long right here at the very first long because the long traded down here, but then we came up and we stopped right at the short, and the bears were strong enough to push us down. Now maybe this little guy does push us higher, and then great, you can just take the next setup. But when you weigh 500 trades that do this, that the long trades, then we stop at the short, and then you look at how many times does the very next 50 in the direction of the original setup, in this case it's long, get enough follow through, and what is the follow through like? It ends up being not as profitable as waiting for the 61.8 to break. And the only way you kind of get to some of those scenarios is to get a lot of trade data. I'm not really a huge back tester or like going with historical data, so just take years and years of real data and watching things like that. At the same time, so Veronica asks a good question, or Victoria, excuse me, asks a good question. Could you go short here? You could up at this 50, but you have to remember that the long has traded first, and again, just kind of waiting a little bit for the 61.8 to break, and then taking the next short is what I would do. You're kind of at a 50-50 in terms of taking the long or taking the short between two 50s like this. If it's really wide, like if it's a really big distance between the two 50s, you can take a short down into the long, take a long up into the short. But at this point, being inside day and right inside the middle of the first 30-minute range, there's going to be more opportunities that are either outside of the first 30-minute range or another long down at lows we might get. But at this point, if we can come down and break the 61.8 just a little more, I might consider a short like that. But see how the long here was just ridden right through by the shorts, and it was indicated by stopping right at that 50. I also like to look at the 30-minute candles and just note the shape. Big body candle right off the bat, a little bit of tail at the bottom. Second 30 minutes, I realize we're not closed yet, but decent rally, taking it all back, and then the shorts just pushing us back down. So 87.75s would be that second short in the trend. And there is room to go to this 81.25, which is the larger long. We are getting low ticks down. It's not the low price, but with that winning trade earlier, I might take a stab at 27.75s if we can get there. We only traded 50s. Usually I try to be pretty careful in the first 30-minute range, but look what we're getting. What's the pattern this morning? Okay, we have one setup in the long direction, two setups, and then the third one fails. And so here, one setup short, that we might get a second setup short. We may roll over before it and not get a short, but 17. We do have a low tick at lows, and with this little dip in here, I might pull the plug on this short and look for something closer to lows in a low tick. '81s is still 5-6 points away. Low tick is 17s. Yeah, Veronica, so I'm passing right here at this little short, so I don't have an order resting here. 53s. Could go either way. I'm so close to 50-50. Being in the middle of the first 30-minute range with a lower high and a potential higher low. Not being able to hit it the first push up is if we I had the order resting when we were back here, but then we got the initial push down and it didn't trade. And so a lot of times that will be enough to, I don't want to go short if we get a double bottom here. The market goes down, gets a little bounce, and then double bottoms and rallies. I don't want to short into a double bottom like that. But in this case, it just didn't quite make it up into the 50%. So even if my order was resting, didn't get filled. But watching very carefully down here between 81s and 83s. And remember, yesterday, the big sell-off was not till like an hour and a half in. So we're still only 40 or 50 minutes into the morning. So if you blow all your bullets, then you don't have any more trades to be able to take. So again, I don't have a limit order here at 87.75s. So we've got that high, low of the day, which happened to be the high and the low of the first 30-minute range as well. We have a lower high up here, a higher low down here with low ticks. That's when you get these low ticks that line up with lows that are not necessarily the low price. And then over here, we've got high ticks that are lining up with highs, but they're not high price. That's also kind of a you get this little triangle formation. Doesn't mean that we'll be in it, all day or all morning, but yesterday, I go back before I do that. NQ pretty much trading the same as the ES. More of a double top-ish in the NQ. But if we go to yesterday, the first hour and a half or so, we had a lot more 60-18 break, 60-18. We bounced for a point or two and then broke the 60-18, broke the 60-18, broke the 60-18, and had this widening formation. We were getting sort of a channel. The lows were getting lower. The highs were getting lower. It was getting wider. Like we started narrow, and then we got wider and wider. And all of this was happening within kind of the first 30-minute range. Most of it had this little dip below. So typically what I do is I use the 2 stop out rule whether I'm having a good day or a bad day. So let's say I come into today and it's just boom, boom, 2 stop outs right in a row, I'll stop trading. Let's say I have a winning trade and then I have 2 stop outs, I'll stop trading. Or 4 winning trades and then 2 stop outs. Or maybe I have a winning trade, a losing trade, a winning trade, and then a losing trade. Well, that's 2 stop outs in the day, so I'm done. So just limiting myself to 2 full stop outs on the day. If I have a couple of trades that I get a first target hit and I end up being like plus a couple ticks or down a couple ticks, but it's not a full stop out, or maybe I get in a trade and I'm able to tighten my stop, so I only take a -4 instead of -6, but I'm getting, some trade. Maybe I have a day where I've got like 5 or 6 trades and half are winners, half are, scratch or small losers. I might continue trading on those days if I'm seeing momentum and try and see if something sticks a little bit later. But 2 full -6s in the ES would constitute stopping trading, whether it's a winning day or a losing day. If it's a Friday, I tend to stop after 1 loser, more so, just because it's nice to go into the weekend on a high note, and I'm okay, having a loser if I executed well and it just didn't work out, or I got a bit of unluckiness. That's totally fine. But I just don't want to, get any sort of on a roll of a bad habit forming into a weekend, or messing with my head or things like that. So I try to do as much as I can to execute the same way and just stop if things aren't going well. Maybe they turn around in the last hour of the day, but if I sit there all day waiting for that, I'm going to make a lot more bad decisions than good. At least I have the opportunity to make a lot more bad decisions sitting there being bored, waiting for a good trade to come along. So yeah, at this point, so Matt makes the point about, if we draw the full retracement here, we're right at the halfway point, basically right in the middle of the first 30-minute range. I don't like to cross through another, I don't know what you want to call it, area of trade. So if I draw from this high to low, we already broke this 60-18 to the upside. So then I would delete that, and I would draw up the long. And I would say, okay, well, we broke this 60-18 to the downside. So we failed 2 60-18s. that puts us in a very range-bound market. So then I would come up and I could draw this high to low, which is going to line up basically with the trading hours currently high to low. So it kind of gets you to the same place, but breaking the opposing here. High tick. Again, I'm just kind of following along here with the drawings, but when you have two failures, a long failure, then a short failure, it's very challenging condition. I wouldn't say today is so bad. Things have been pretty clear, and we've had, a couple of moves in one direction before a failure, and then we change direction. We have a couple of moves to the long side, and then getting reactions at 50s, which is good. This 87.50s, again, given the context, it makes it higher risk because we're right in the middle of the 30-minute range on an inside day. But the structure of the setup, if we were to just look at, we have a larger retracement, and then you draw up the very first 512 to follow. We break the swing low, and we break the opposing. That setup is the exact same setup that I would look to execute across different markets or different time frames. See, 93.50s to 85s. Yeah, I think I got that. But it's just important to remember that, when we keep failing the big 61/8s like this, that there's a better chance that we'll come up and fail this one as well, or keep sort of staying within the first 30-minute range for a little while. Because the idea is not just to get a first target. The idea is to get in a trade that, the first target allows you to reduce the risk on the trade so that you can have the wherewithal to trail your stop and feel like, okay, I'm in a free trade. See how, okay, yeah, it's great that this little short came down and hit the first target, but you're not gonna get rich just taking scratch trades. If you had 3 contracts and you took one off at +2 at 2 points, and then you tighten your stop a little bit, now you only have 2 contracts left, and you've taken a little bit of profit on one. So now all of a sudden, you're basically, your risk has been taken away. So as the trade, if it continues in your favor, then you have kind of a clearer head. Okay, the worst case scenario is I'm break even, or I'm plus a couple ticks, and so then you can really manage the trade well. So that's the whole idea behind scaling out of positions that are getting a little bit of momentum. You don't want to take you don't want to put on 10 contracts and take one off every 2 ticks, because if you're risking 6 ticks, your risk to reward is going to be really bad over those 10 contracts. You have one loser, and if you're taking half off at 2 ticks, it's not going to be sustainable. But if you do 2 points, Now you've got better numbers. On the slide yesterday, I noticed that a lot of these heavily traded stocks, Apple, Google, Netflix, Amazon, actually Netflix was really the only one I think that was a little bit down yesterday, but the Amazon was up, Facebook was up. And then here we go, right through that 61.8, the same thing that we've been seeing, and in another kind of high tick, not the high of the day. So the pattern continues. $94.25 is yesterday's value area high. Pull over my market profile chart. So here's today. We opened up here. Here's the top of value area for yesterday. We're currently trading down about here. And if we look at what we have to the left, quite a few pointed controls, a lot of trading around this 27.90 area. We traded down here, which was about the lows from, what would that have been, Wednesday, Thursday area. And so you can see a lot more resistance and congestion to the left than we've had in the past. So I just this market profile is just in Excel, and I just kind of go through and do the letters myself and mark it up. You can use, if you're on like Thinkorswim, there's software out there that does it for you. I think Sierra Charts has a version of volume profile. Thinkorswim has the monkey bars, and both are totally fine. So these different lines that I've got on my chart, we'll use this day back here since it's a little bit smaller. Before I do that, I'm just going to draw up the long and kind of expect that to fail. But one thing I wish TOS had was a shortcut to just click and delete. All right. So if this is the day's profile, just constructed by every 30 minutes drawing up a letter that corresponds to price that traded. So in the first 30 minutes, I just have A, and we started at 27.93 and a quarter, traded down to 86.75s. And then the B column would just be where we traded the next 30 minutes, and then I'm justifying over to the left. So here in the second 30 minutes, we traded lower than the first 30, thus it gets pushed over to the as far left as I can go. So then by the end of the day, you take the area or the row with the most number of TPOs, they're called time price opportunities, the area with the most number of TPOs, and that becomes your point of control. When you've got a couple of rows that are equal, then I look for the one that is most centered between above and below and the other TPOs. It's close is close enough. You could put value area here, or the point of control, or you can put it here. It doesn't really change anything. But the point of control is the row with the most number of TPOs. So that's here, and that's noted by this price. And then you just take a standard deviation, so 70%. So if we had 100 TPOs, I would count 70 of those on either side of the point of control, starting with the largest. So I would add this column, and then I would add the next column, which is one less, and then these two I would add in next because they're bigger than the prior. Add this guy, and I would take these over here. And so you just kind of keep going, standard deviation on either side until you get 70%, and then that becomes your value area, and just marking value area high and value area low. So that's where 70% of trade took place for the day. This is a very balanced profile with a point of control basically right in the middle, and pretty even point of control. You get a day like yesterday where you have a very narrow rows or narrow columns profile in general. Then here you have like some single prints. The market's just kind of selling off, only trading for one 30-minute period at that price. And then we kind of come down and spend more time a little bit lower. You end up with a really long value area. And then as the days start to build on each other, you can kind of see how, okay, the point of control is starting to get lower and lower, and then we jump up here, and then the next day we kind of jump down. But as you look at the last 5 or 6 days, you can see where a big chunk of overlap is, like where a lot of trade took place. And when you get in situations where you get single prints, or the market coming back into a prior value area, those point of controls, value area high and low, can act as support and resistance. So it's just another way of kind of looking at the markets, interpreting the data. I don't really use it like if we break a certain level, I'm going to put on a trade. It's more for getting an idea of where good trades might be likely to trade. So areas that I want to trade versus trade signals. Single prints are definitely weaker, and so if I see a bunch of single prints above us, then there's a better chance that we can move up through those single prints a lot easier. If I see a whole bunch of columns above us, so like in the example day back here, if we were moving down, well, let's say we're over here. moving down, 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 there's a lot of trade that took place over here. So there's probably going to be a lot of resistance or support, excuse me. If let's pretend that this was the only day to our left, single prints, and we start moving up into this area, well, then we should be able, there won't be much resistance through here on this day. If we come over to the left, we can see, okay, well, there's a little bit of resistance on this day. But as we, like this spot here, we should be able to go through 07s to 09s pretty quickly. So if I saw a long right here, my expectation is that, yeah, we could break out and trade up to, this thicker area quicker than we would, breaking out from highs of today and maybe moving through this area. So you can gain a lot by looking at the chart as well, and kind of, especially when you're looking at the 30-minute chart, you can kind of see, okay, well, here the market traded a handful of 30-minute bars in this area. So far today, I could draw a box around basically the opening hour here, and we can see that there's a lot of trade taking place. So you can visually see things, and your eyes will get trained over time. But the market profile I do find to be very helpful. And it's just, it's a methodical part of my routine now. So I kind of enjoy the process. It forces me to really pay attention throughout the day. I'll chart it as I go here in the morning, and then usually I'm done after a couple hours, and then I come back at the end of the day and finish charting it. Or if I'm stopping in throughout the day to watch, then I'll chart it as well. Now, so Matt asks another good question. Do I take a retest? 99% of the times I don't. Maybe one or two instances where I might consider it on a case-by-case basis, but for simplicity's sake, I'm going to say no. I don't take retests, because I figure if the market came down to the long and wasn't able to be bought up the first time and then kind of fell back down, I don't want to be sort of, there's fewer buyers. There's some buyers that already got long, and if they couldn't push it up, now there's going to be fewer buyers on the next retest. Sometimes the market will retest 3 or 4 times and then break out. I'd rather just wait for the breakout and take the next setup and then have all that support underneath. So I'm kind of if I didn't catch it on the first one, I'm not in it. I never really look at I guess I shouldn't say never. So the ticks making this kind of higher highs as well as lower lows. I don't look at the patterns that much on the tick. So the trend or the pattern of breaking the 61.8 continues, broke the short, now broke the long. That's the 4th failure. And that's to be expected inside of this first 30-minute range. So today is a really good example of, an opening range bound first 30 minutes. If you want to kind of categorize your days or print out the chart and compare it with another 30-minute range bound day. Anytime I see tails or wicks that are really long, if they're in, like yesterday, a lot of bottoming tails, that does show or indicate that, bulls, if we think about what happened over that period of time to make that candle, price opened, price fell, bulls pushed it up into the close of that candle. Next candle, price fell, bulls pushed it up. Next candle, same thing, price fell, and then bulls pushed it up above the prior candle's high, and closed bullish. So seeing tails like that does give some strength to, if they're pointed down, to the bulls. In this case, if they're pointed up, perhaps to the bears. But just like, at the open, we had of yesterday, we had some bottoming tails. If those fail, then failures usually lead to really strong moves in the other direction. So let's say today we move up above today's high, then we should get a strong move in that direction. But at this point, both of these candles are still within the first 30-minute ranges candle. So for that reason, kind of trying to stick with placing trades around the top, or around highs and lows is where I want to be. Yeah, and then continuing with, kind of low ticks in these lower prices, not low price of the day, but, just even buying up in low ticks like this, buying low ticks and selling high ticks. I mean, the NYSE tick is the kind of go-to tool for day traders who trade the E-mini S&P. Take a peek at a 5-minute. Man, does that look messy compared to the trending part of yesterday. And you can really see the triangle here. Lower highs, higher lows. So when we get maybe one more time of a lower high tighter, we should get a break. It may take a little bit, or it may only take 20 minutes, but that's what's developing. And that makes sense. We've got a short above us, a long below us, and we're kind of right in the middle of that. And then yet again, back through the 61.8. So the pattern continues. If I were to see when we get to the point where maybe we make a lower high here, and then let's say the next long trades at the 50 and trades up to its target and breaks one of these swing highs or swing lows, then boom, red flag goes off. Okay, this pattern of failing 61.8s is now changing. Let me keep my eye out for a potential trade. So just like, we're looking at patterns and chart patterns and technical analysis, looking at patterns of the way the price is moving and different little nuances. That's why it's really helpful to really focus in on one market so that you can really begin to pick up on a lot of that. NASDAQ also looking pretty messy, although breaking its highs of the day, but we already determined that the NASDAQ was the stronger one of the bunch of the top four, the Dow being the weakest, and pretty much just a mess like the ES. I wouldn't be surprised if we drifted above or below the first 30-minute range today. If we go down, I would expect something at 81 and a quarter, sort of bounce. But we may go more of the day just kind of sine wave if we drift above or below and then just kind of come back into the day's range. Daily chart wise, we'd have to go a really big move to obviously get out of yesterday's 50-point range. So it's probably going to take a couple days for us to do that. So you don't force things, you just take what you can get and focus on how can I reduce my risk as much as possible, or not take risks that are not going to, put yourself in positions that are going to give you the best opportunities. That goes for, trading and, meeting people. If you're out at a networking event or a social or things like that, you don't want to just stay in the corner. You want to put yourself in positions that's going to be in the middle or around people, even if you're just, you want to talk with someone who's fairly popular or desirable. Just standing around their circles is likely going to put you closer to people who are similar to that person. And, with trading, trying to keep things as the same as possible each day helps to give some structure and some consistency through, a market that's going to do a lot of different things. Yeah, typically a wedge formation like this would follow through in the direction that we were coming into it. So yesterday, I guess you could say, it was a little bit mixed of both. we moved down. But then if we just look at from the lows of yesterday to today, we kind of have a bull flag where we rallied and then we moved sideways. But if we look at the bigger trend and the short that's holding, it could kind of go either way. In this case, I would wait more on the downside at this point in the day, or at this point in this trend, because the short traded first. But if we zoom out even more, we can say, okay, well, the last week was kind of sideways, but the general trend in the daily or the weekly has clearly been up. But it might take a couple days for that new trend to become clear. But this is always the first sign, the break of the swing low. And if we go back to October of last year, same thing was happening. We had these little pullbacks. They were bigger than this recent rally, the first 2 months of the year. We were pulling back deeper, but we were holding the swing lows the same exact way. And then we had a break of the swing low in beginning of October, and then that started the sell-off or the trend change. I'm not saying that it happens like that every single time, but I'm just looking for the same things over and over again. It's not changing the way I assess the markets, whether we're in a bull market or a bear market. You might be looking for longs versus shorts, but the actual way I go about my day is exactly the same. Now, the VIX isn't really... So keep in mind the actual number of the VIX is still super low in the mid-teens. I'm really concerned with more of breaking swing highs and breaking swing lows. The intraday stuff doesn't mean a whole lot. If all of a sudden we were to spike in the VIX and break yesterday's high, that would I would make a note of that. But as of right now, the S&P is just in the middle of its range as well. So getting tighter. Might only be another 15 minutes. It might be a couple of hours. But at some point here, we should break in one direction or another. And it may only be a break that takes us to the highs or to lows of the day. It may not be another big, fall off a cliff kind of thing like yesterday, a couple hundred points in the Dow. But these swing lows or these swing highs are going to be kind of the start of it. So far all morning, we've made major highs that are lower, 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 and major lows that are higher, higher, higher. So we just look back to the most recent one, this guy up here, or this, we'll call this the gal down here. The higher the low, that's most recent. And if one of those starts breaking, then I would come in and start looking at, okay, potential short as we get down towards making new lows on the day. But keep your eye on the NYSE ticks, because if we come up and make a high, then we get a high tick at highs, well, then that's a great opportunity to just take a short and fall back down. And if we come down and make a low, and then we get low ticket lows, and then we bounce, well, all that is an opportunity to fade the short. Yeah, that's right, Matt. We're running out of letters to take this wedge to the apex. So, and I mean, look at the 30-minute chart. It's just tighter, 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 smaller, smaller, smaller. At some point you're going to break, but all of the indications that kind of set the tone for the start of the day have capitulated and confirmed and kind of just added to that same analysis. So we're kind of in the same spot we were at the beginning of the day with our initial thoughts. And that's always a good place to be. Market's always going to throw curveballs, but if we can have more of a framework that we follow, then it makes that easier to come up with some different scenarios, A, B, C, D, different things that could happen. But in general, always focusing on how can I come to a trade, looking for opportunities, and then assessing the risk of it before I look at the reward. So I think we'll leave it at that for this morning. Some good questions in there today, and good discussion, I felt like. So if you have other questions or things you want to throw at me throughout the week, feel free to shoot me an email, tim@eminimind.com, and happy to help out or answer any questions as best I can. So thanks for tuning in, everyone. We'll talk to you soon.